April 17th, 2026, the Federal Reserve, the OCC, and the FDIC issued the first revision to model risk management guidance in 15 years. 15 years. That alone would have been a major event for banks and model risk teams and chief risk officers and even board risk committees. SR 11.7, it shaped an entire operating discipline. It gave people language and process and evidence standards and a way to explain model risk to supervisors. But the most important part of SR 26 may not be what it governs. It may be what it deliberately leaves out. Generative AI and agentic AI are outside the scope of this guidance, not because they are unimportant, not because they are low risk, because they are moving too fast for this guidance to prescribe them plainly. So, this episode is about that gap. More precisely, it is about how serious institutions should govern inside that gap before the agencies fill it for them. This is the Ether Vector Podcast AI Ethics Policy and Governance Series. I'm Louis Maverick Adams. I'm the managing director of the Ether Vector and someone who has spent more than 20 years inside the institutions that this guidance is actually aimed at. Today, SR 262 and the Agentic Governance Gap, a practitioner read for the people who have to turn guidance into operating discipline. Before I get into the substance, let me be very direct about what this is and what this is not. There is a lot being written right now about SR 262. Some of it is academic, and some of it is, of course, aspirational from people who want to be part of this conversation, and they are working towards that. However, what I'm offering is different. I have built governance frameworks inside institutions exactly like the ones this guidance is aimed at. I have been in rooms where regulatory guidance arrived and watch what actually happens next, not observed from a distance inside those rooms. That is a perspective that I am bringing to this episode. So here is the thesis. Institutions that treat SR 262 carve out as a governance design obligation, they will enter the next regulatory cycle with evidence and operating patterns and supervisory language of their own. Those who wait will build under prescription, and that prescription, it usually arrives after something breaks publicly. That is the argument. Everything that follows is the evidence for it. Let me start with the fact pattern because the fact pattern matters here. SR 262 was issued jointly by the Federal Reserve, the OCC, and the FDIC. It supersedes SR 11.7, which came out in 2011, and SR 21.8, the BSA and the AML model risk statement from 2021. That matters because SR 11.7 became more than guidance. Its practice, it became part of the operating language of bank model risk management. We had terms such as development and use, validation, governance, annual review, effective challenge, model inventory, documentation. Those phrases became a professional grammar of their own. SR 262 does not throw that grammar away, but it does change the register. It moves the industry from a more prescriptive posture to one of more principles based posture. It says in plain terms that this guidance does not establish enforceable standards or prescriptive requirements. Now, some people will hear that and think the standard went down. I read it differently. I think the burden moved. Under the old regime, people could point to process. And under this regime, they have to defend judgment, which is the way it should be. Annual revalidation as the default is no longer the center of the operating model. Materiality is. So, this is not the first time regulators have made this move. I remember working through Sarbanes-Oxley 404 in its early years. I was doing internal controls over financial reporting, which is better known as ICOFR. I was doing ICOFR work at the time, and so the documentation burden was real. The original requirement was effectively a one size fits all. Companies spend enormous resources documenting controls on processes that carried virtually no material financial risk. And so the pushback was loud and it was sustained. By 2007, that guidance had been substantially revised. AS5 replaced AS2. The SEC issued separate management guidance, and the whole posture shifted toward a top down and risk based assessment focused on material weaknesses. That revision became the durable standard. SR 262 is following the same arc. The domain is different and the pace is faster, but the underlying logic is the same. Prescriptive requirements create compliance burden without proportionate risk reduction. And eventually the framework corrects. So purpose and exposure matter. Inherent risk matters. Use matters. If a model is immaterial, the governance intensity may be lower. However, if the model is material, the institution needs a sharper control environment and a better evidence trail. So far, that is manageable. Hard, yes, but manageable. But then you hit the carve out. Generative AI and agentic AI are novel and rapidly evolving, and they are not within the scope of the guidance. That is the inflection point. The systems moving fastest, the systems most likely to reshape decision workflows, and these systems already showing up in customer facing, credit, risk, operations, and documentation processes. Those are not covered by the main federal MRM guidance update. That does not create a permission to wait, it creates a design obligation. Institutions that build a parallel governance framework now will have something to show when the next regulatory cycle arrives. However, institutions that wait may find themselves building under someone else's emergency language. So I'll leave you with this in this segment. Out of MRM scope is not the same as out of governance scope. Carve out language is short enough that it is worth hearing almost in full. The guidance says generative AI and agentic AI models are novel and rapidly evolving. As such, they are not within the scope of this guidance. That sentence is doing a lot of work. It tells us the agencies are not blind to this issue. They see it, they are naming it, but they are also telling the market that this document is not the final answer for that class of systems. Now, out of scope does not mean outside supervision. It does not mean outside consumer protection. It does not mean outside unfair, deceptive, or unsafe practices. And it definitely does not mean outside internal risk management. And for anyone thinking that being outside MRM scope means being outside everything, I want to push back on that very directly. Let me walk through what is still very much in scope. Think about the adjacent framework stack. The EU AI Act still gives us a risk based approach, documentation expectations, transparency, and human oversight. The NIST AI risk management framework still gives us govern, map, measure, and manage. The NAIC model bulletin is very direct about this. Decisions affecting consumers must comply with the law, regardless of the tools used to support those decisions. Colorado and Texas have moved into state level AI regulation. The OSFI E23 in Canada is explicitly attended to AI and autonomous decision making in model risk management. So the gap is not empty, it is crowded, but it is not yet harmonized for large US banking organizations using generative and agentic systems at enterprise scale. Here is the scenario I would use with a board risk committee. Imagine an underwriting team that deploys a retrieval augmented assistant. It pulls credit policy, summarizes borrower information, drafts a credit memo, highlights exceptions, and recommends escalation language. Is that a model under SR 262? Maybe not. If the system is not producing a quantitative estimate through statistical, economic, or financial theory, the narrow model definition may not capture it. But is it consequential? Absolutely, it is. It is shaping what the credit officer sees. It is framing the exception. It is deciding what policy language gets pulled into the memo. It may not approve the loan, but it can influence the human who does. Then the real question becomes, who governed the retrieval sources? Who approved the prompt? Who decides whether the memo language is reliable? Who logs the override? Who monitors whether the assistant is creating different credit narratives for different borrower segments? Who can stop the tool if it starts retrieving stale policy? If the institution cannot answer those questions, then the system may be outside MRM scope, but it is inside governance risk. So I'll leave you with this in this segment. The carve out is not the regulator saying these systems do not matter. It is the regulator saying they cannot keep pace with how fast these systems matter. This is where I think practitioners need a different lens. Do not read SR 262 only as a compliance document. Read it as architecture. The document elevates four ideas that matter well beyond traditional model risk. First, materiality based oversight. Second, effective challenge. Third, aggregate risk awareness. And fourth, governance proportional to risk. Those are not just MRM ideas, they are decision system ideas. Materiality applies to any system that drives or shapes a consequential decision. If an AI assistant changes the way a credit officer reads a borrower, then materiality matters. If an agent routes a customer complaint, materiality matters. If a generative tool drafts model documentation that validators rely on, materiality matters. Effective challenge applies to any judgment that is delegated to automated processes. The challenge cannot stop at the mathematical model. It has to reach the prompt, the retrieval layer, the tool calls, the orchestration rules, and the monitoring logic. Aggregate risk applies because agentic systems are chains. A retrieval service feeds a language model. The language model calls a classifier. The classifier routes a case. The routing decision triggers an action. None of those pieces may look catastrophic in isolation. Together, they can become decision infrastructure. Proportional governance applies because not every generative system deserves the same control burden. A brainstorming assistant for internal training content is not the same as a credit memo assistant. A marketing copy draft is not the same as an agentic servicing system that changes customer treatment. So, the practical move is this: take the principles from SR 262 and extend them into the carve out class. Not because the guidance requires it, because sound governance requires it. So I'll leave you with this in this segment. SR 262 is more useful as a blueprint than a checklist. Read it that way, and the carve out stops being a problem. It becomes a design space. The next question is where judgment lives. That is the question I do not think institutions can dodge. Quant Human is my framework for this problem. It is a leadership and operating model for AI augmented decision making. The point is not to romanticize human judgment. Humans make mistakes, humans carry bias, humans can be slow, but humans also carry accountability, context, ethics, and institutional standing. Those things do not automatically transfer to a model endpoint. In an agentic system, the human can disappear without anyone formally deciding to remove the human. The process gets automated one step at a time. First, the tool drafts the memo, then it recommends the escalation, then it routes the case. Then the exception workflow accepts its recommendation. Nobody, nobody says the machine is in charge, but functionally, the room has shifted. Quant Human makes three operating moves, and I want to be honest here. These are not theoretical. I have watched organizations skip all three and pay for it later. First, algorithms detect, humans decide. For consequential outputs, a human role needs explicit decision rights and override authority, not a ceremonial review. A real ability to stop, override, correct, escalate, or change the system. Second, effective challenge moves upstream. In traditional model risk, people think about conceptual soundness, inputs, methodology, assumptions, validation, and monitoring. In agentic systems, some of the most consequential design choices sit before the model response, the prompt, the retrieval source, the chunking logic, the confidence threshold, the tool permission, the escalation rule. Third, materiality is a leadership question. Technical teams can measure behavior. They can explain latency, response quality, error rates, grounding, or drift. But materiality asks what consequence the system creates for the institution. That belongs with executives and risk governance. Let me make it concrete. Suppose a credit pipeline uses retrieval to pull policy, classification to assess exceptions, a language model to draft rationale, and a routing agent to move higher risk cases into manual review. Where does Spot Human enter? At the retrieval layer, someone challenges whether the sources are complete and authoritative. At the prompt layer, someone challenges whether the instruction biases the memo toward approval, denial, escalation, or risk avoidance. At the routing layer, someone challenges whether threshold choices create disparate outcomes or operational bottlenecks. And at the executive layer, someone decides whether this workflow is material and how much governance it needs. That is the room. The danger is not that humans are absent from every step. The danger is that no human owns the whole chain. So I'll leave you with this in this segment. The institutions that govern AI well are not the ones with the best models. They are the ones whose humans never lost the room. One human tells us where judgment lives. Triple guardrail tells us how to make that judgment operational. The framework has three layers: data guardrails, model guardrails, and market guardrails. In a traditional environment, those may look like separate control disciplines. And in agentic systems, they have to operate as one fabric. Start with the data guardrail. For a generative or agentic system, data is not just a training set or a table in a warehouse. Data includes the prompt, it includes retrieval sources, it includes system context, it includes tool outputs, it includes policy documents, customer records, transaction histories, call summaries, and the intermediate reasoning artifacts that shape the final output. So the control question is no longer only whether the data was accurate at model development. The question is whether the institution can prove what information shaped the decision at the moment of use. Then the model guardrail. This is where the SR 262 definition matters. Many generative systems may not be models under the narrower definition, but they still produce outputs that shape decisions. In an agentic workflow, the control point is often the boundary, the handoff, the moment retrieval becomes generation, the moment generation becomes routing, the moment routing becomes execution. If you only govern the component, you miss the behavior of the system. The boundary is where the risk moves. Then the market guardrail. This is the guardrail many institutions underweight because it sounds external. It is not. Market exposure is part of governance. A generative failure can be screenshotted. An agentic failure can be reproduced. A flawed customer interaction can become a reputational event before the first internal committee convenes. That means staged rollout, bounded exposure, kill switches, rollback readiness, customer impact monitoring, and confidence sensitive release patterns are not just product management techniques, they are risk controls. The synthesis is straightforward. SR 26 tells us what good governance should feel like at the principal level. Triple guardrail tells us how to build that governance into the operating layer. So I'll leave you with this in this segment. Governance that runs after the fact tells you what already failed. Governance that runs at decision time tells you what is about to fail. Now, let us make this practical. What should institutions actually build? I would call it a bridge architecture. It is a parallel governance framework for the carve-out class. It mirrors SR 26.2 where the principles fit, and it adds controls where generative and agentic systems require something more specific. For boards, the starting point is not technical. It is visibility and accountability. The ask is where in the institution are generative and agentic systems making or materially shaping consequential decisions? Another asks who has decision rights when those systems fail? And another ask is what is our materiality threshold for the carve class and who owns it? Those are board level questions because they go to risk appetite, accountability, and institutional trust. For chief risk officers, the funding question is equally direct. Fund the parallel framework as critical infrastructure, not as a one off AI project, not as a compliance exercise that sits in a binder. The framework meets operating capability. This is where I use the real time decision spine as the technical scaffolding. Think about signal intake, feature and retrieval governance, modeling and scoring oversight, optimization with guardrails, execution lineage, evidence and explainability. Those capabilities need to sit across the decision chain, not at the end of it. And for operators, the build list is concrete. Build the control points, build override paths, log overrides in a way that can be reconstructed. Monitor drift for systems that do not behave like traditional models. Version prompts, track retrieval sources, record tool calls, define kill switches, stage rollouts, capture evidence that an examiner, an auditor, or a board member can actually understand. And here is the timing point. Institutions that build this in the next 2 quarters build on their principles. They can test, they can refine, they can create language that fits their business model. Institutions that wait may build under prescription. And prescription, it usually arrives after something breaks. I want to be honest about something here because I have watched this pattern play out more than once. When guidance like SR 262 arrives, the first institutional instinct is usually to parse the scope language carefully and build the argument for why most of the existing portfolio qualifies as out of scope. The second instinct is to rebrand the current governance program as already compliant without meaningful change. Then someone drafts the trade association communication, often before the guidance has actually been read. The carve out gets read as a permission slip rather than a design obligation. And I understand why it happens. It is a rational short term response, but it produces the same outcome each and every time. Nobody wants to be the case study that writes the rule. And I'll leave you with this in this segment: build under principles now or build under prescription later. Those are the only two options. And the institutions that pick the first one will write the language that the second one is built from. The agencies have signaled that a request for information is coming. That is not background noise. It is the next terrain. Between SR 262 and the eventual federal approach to generative and agentic AI, institutions have a choice. They can wait for the agencies to tell them what good looks like, or they can build what good looks like, gather evidence, and enter the conversation with credibility. I think the second path is the stronger path. It is also the safer path. The history of model risk regulation is fairly clear. More prescriptive language often follows failure, litigation, examination findings, or market harm. That is how complex systems get regulated. But institutions do not have to wait for failure to build a standard. This paper and this episode are part of the Aether Vector AI Ethics, Policy, and Governance series. The next pieces will take this from thesis to operating tools, an SR26 reading map, a carve out governance scorecard, and a reference model for the real time decision spine in regulated institutions. The goal is not to predict every sentence in the next guidance. The goal is to make sure serious institutions are not surprised by the direction of travel. And so I'll leave you with this in this segment. The carve out is not a gap in regulation, it is an invitation to govern. The written practitioner read is available through the ethervector.com. It includes the 7-section argument, the bridge architecture, and the framework references behind this episode. This has been the Ether Vector Podcast AI Ethics Policy and Governance Series. I'm Louis Maverick Adams. The next episode continues the operating question: how institutions turn AI governance from policy language into decision time discipline.